there are 5 crucial mistakes that people make with their super that can be costing them thousands of dollars. In this video, we'll go through what each of those mistakes are, and more importantly, how you can avoid those mistakes or fix them so that you can be saving those thousands of dollars instead of costing you. My name is Daniel Thompson. I'm a financial advisor and the founder of New Era Financial Planning. And as I mentioned in this video, we'll go through those top 5 super mistakes that I see and that we see as financial advisors, and what you can do to avoid them and keep more money in your pocket. So starting and jumping in, the first mistake and the biggest one that we see is people either ignoring or not knowing about their super. So when I say this, it's about who you're with, just the basics and high level, who you're with or which super fund you're with, what the current balance is approximately, and how it's invested. So a lot of people, usually most people, just get an annual statement, for example, from super, chuck it out or put it away and don't really look at it. Sometimes they don't get that or don't even get that because they've moved. So the super fund might have an old address and not have updated to the new one. So it's important to make sure that the super fund has your details and that you're getting those statements and that you're checking it to know how it's going, what the balance is, and as I said, even who it's with. Some people do ignore their super because they feel that it's not their money, and I understand this. There's a bit of a disconnect. If you had $50,000 or $80,000 in the bank or even in other investments of your own money, I say this to a lot of people, you would know a lot more about it. You would keep an eye on it, know how it's going, how it's invested, and that type of thing. Because super is usually set up by an employer, usually your first job, and there's money being put in there by your employer, not yourself, usually directly. It doesn't feel necessarily like your money, and it's a bit of out of sight, out of mind, which is a good thing, and you can't access it until your retirement or a long way into the future. So a lot of people don't really worry about it or keep on top of it because of that. However, it is a very important thing to do to have a good idea and understanding of at least those 3 key parts of your super: who it's with, what the balance is, and how it's going, and then you can delve further from there. So to avoid that and solve it, make sure you are getting an annual statement each year, either via email or post. If you're not, find out or call up your super fund and update, or find out what address they've got and update those details. Almost all super funds nowadays have online access, so register for that, jump on it. I know it's a pain because usually you'll have a bank online access, an investment one for your shares and ETFs, a super one, but it is important to have them and be able to check it occasionally. You don't need to check it often, but at least know how things are going and how it's progressing. That leads to the next common problem that we see, and this one, in fairness, has reduced a bit over the last, or quite a bit actually, over the last 5 to 10 years, and that's having multiple super funds. So it's a lot easier now to find those super funds and merge them, and there's a lot more information around about not having multiple super funds. There's two parts to why this costs money. One is the obvious one, the fees. There's sort of extra member fees and admin fees and investment fees across different super funds. They've largely come down over time as well, so it's not quite as bad as it used to be, again, 5 or 10 years ago. However, the second issue remains, which is what I sort of call complexity. By having multiple funds, you've got to make sure they're set up the right way, and you might have your main fund, which is where the money's going in and going well, but then you've got these other funds around that aren't performing or aren't doing what you're supposed to do, and they're not. It's not all in sync, and it's not pulling you in the right direction or the same direction. So the way to fix this, if you do think or you do have multiple super funds, is there's a couple ways. You can jump online and Google the ATO Super Seeker, or if you've got the ATO linked to your MyGov, you can log into your MyGov, go into the ATO portal through that, and that should show you the super funds that you've got based on your tax file number and an approximate balance from the last financial year. So it won't be an up-to-date, but it'll be an approximate balance of those funds. So you can then see what funds you've got and roughly how much are in there. You can then either contact those funds or even with your main funds, reach out to them to get them, whether it's a form or get them to merge those other funds and combine those other funds into the one. Now, something to be aware of with this, and a big caveat, is those other super funds may have what we call default insurances inside it. So things like life insurance or permanent disability, even income protection. Usually they're set up when you would have set the super fund up. Some may have continued, some might have been cancelled. It's important to know and check if you do have any insurances in there, because if you transfer the money from, say, super fund B into your main fund, super fund A, super fund B closes down and that insurance gets cancelled. It doesn't transfer across with the super money, so you will lose access to that all those insurances. So what we generally like as a rule, as a minimum, is to increase it to be able to maintain that amount of insurance, or ideally have a look, and this is where I do recommend getting some help with the consolidation and the combination of both the super and potentially any insurances to make sure you don't lose out on anything. You've got enough for what you need and you've got the right amount, so that you're not sort of paying too much, but you're not what we call underinsured and not got enough in case something happens. So that way you can merge the super funds, but at the same time make sure you're not losing out on anything that you've got. And this is where even looking at the different super funds, so super fund A, although it's your current one, might not be the right one for you. It might be super fund B or even another super fund. So again, reach out. It is important to have a look and get some help with this. You can jump initially for some research on CanStar, and I'll talk about that more next. But it's important to know what you've got and what's available to you, and make sure you're in the right fund if you've got multiple funds. So that's probably a nice segue to the third common problem that we see, and that is being in an underperforming super fund. So again, these days, it's not as common as it was 5 or 10 years ago, because there's more reporting about underperforming funds. There's the Fat Cats report that comes out each year, and there's some good comparison sites, or decent, I should say, at least comparison sites now, to try and compare some of the better performing and better funds around. It is very difficult to do this at a high level because different funds call their investments different things. The underlying investments are usually pretty different and what they invest in. So you've got to really make sure you're comparing like for like and apples to apples, as they say. This is where, as I mentioned earlier, tools or websites like CanStar can help at least the initial stages and high level, because you can jump online, have a look at a range of different super funds and a period of time. So they look mainly at 1 year and 5 year returns. My preference is longer term, to look at over a 10-year return, because it keeps a super fund honest over the longer term. A lot of funds can have a good 1 or 3 year period, but to make sure that they're consistently performing, that's what we want. But it can at least give you an idea of some of the super funds that you can then jump onto their websites for and look into more detail at how they're invested and the returns that they have for each of those investments. So if you do believe you have an underperforming fund, or you're not sure, you can jump on and have a quick look, see what your fund is returning over time. Almost, again, all the super funds have websites which report their performance over time across the different investment options and different timeframes, so 1 year, 3 year, 5 year, 10 year, that type of thing. So compare like for like. Usually the longer the better, because I said, a super fund can have a great year or few years, but still be underperforming over the longer term. Again, this is where, like the previous point, I really do recommend it is good to get some help or support and advice with this, to make sure you are comparing like for like. So as an example, super fund A might have what they call a balanced investment, or they call it balanced, which most people logically think it's like a seesaw. It's balancing. It's sort of 50-50, half aggressive, half defensive. When I say aggressive, we're talking things like shares, ETFs, potentially property and that type of thing in there. Whereas defensive is things like just cash, money in the bank, savings, what we call bonds and fixed interest, and those type of things. So aggressive grows and makes returns, but it's up and down. Defensive is fairly stable, provides an income, less volatility, but not as big returns. Whereas in reality, most balanced funds are anywhere from 2/3 to 70%, even higher to 3/4 of the money is invested in growth assets. So some we find might call themselves balanced, some might call themselves a balanced growth. One balanced fund might have 70% of that investment in those growth assets. Another one might have closer to 80%. So when you compare those two on the same, and they both call themselves balanced, for example, the one with 80% in aggressive assets will or should, all else being equal, outperform the one with only 70%. So that will look better on paper, but when you look deeper, the reason is that they're invested more aggressively, which might not be suitable for you because it's going to be riskier in the sense of more volatility and more ups and downs. The other thing to keep in mind is even within that sort of 70 or 80% of shares and ETFs and those type of investments, there's a whole range of different industries and countries that can be invested in. So again, super fund A might be pretty standard, straightforward. They're 70% Australian shares, US shares, maybe Europe and that type of thing, more the developed and bigger companies and a bit more stability. And it might be aiming just to get market linked type of returns, whereas super fund B, their one might invest more in things like emerging markets. So we're talking Russia, well, maybe not Russia so much anymore, Brazil, India, China, and those sort of developing and emerging economies still. So there's a lot more volatility associated with that, but potentially better returns as well. They might also, and this is where making sure it's right for you, invest in certain industries, whether it's technology, whether it's renewables, whether it's fossil fuels and those sort of things, that might mean they either outperform or underperform from an investment point of view. So this is where it takes a lot more research and delving into the underlying investments and setups than just the high level. So again, you can do that. You can go into the investment guides and the PDFs that are on the Superfund websites and available for everyone. But this is where I really do recommend getting some help and support for this part, because it can make a big difference and does take quite a lot of time and sort of knowing what you need to be looking at. Having said that, the way to really make sure you're in a good performing fund is to do that research and either yourself or get some support and help with it, and make sure that the fund stacks up on a like-for-like basis with at least the average, if not a little bit better. Quick note on this one: when we talk about underperforming as well, there's two parts. One is underperforming at a general level, which is just the average, or underperforming the benchmark, so to speak, or what you could get if you just invested elsewhere. The other one is underperforming what you need it to be. So this is where it becomes more personal and tailored, and comes into that getting some support and advice, because you might need it to be performing here, and it's performing here, but it's basically doing market returns, benchmark, that type of thing. So you might look at that and say, hey, it's going well, but it's not enough to basically meet what the amount you need at retirement. Or it might be the other way. It's actually performing well, but you don't need it that much. It's going up and down quite a lot, and you're a bit concerned about how much it's fluctuating. So it's more than making sure, A, it's not an underperforming fund in general, and B, that it's performing in line with exactly or as close to what you need it to perform over time to meet your specific retirement goal and number, which we talk about in another video. So jumping from there to the next key issue that we see with people is having a high fee fund and an overly expensive fund. So this is deliberately down the list a little bit. I didn't lead with this. A lot of ads on TV are about this, and a lot of people, this is sort of the top of mind thing. But for me, again, and generally as advisors, you get what you pay for. There's a range of different super options available and types of super funds. Some are low cost, some are average, and some are more expensive. But it depends what you need. So if your fund is extremely expensive and underperforming, then you need to get out, essentially. However, sometimes it is okay to pay a little bit more for access to different investment options. So people that want to invest in certain things, for example, whether it's renewables or technology, or include or exclude certain countries or industries, usually you need to have a super fund and pay a little bit more for a super fund that allows you to tailor a bit more. If you're starting out, or the balance is lowish and you're not too concerned about that, at least right now, it might be more worthwhile to be in a low-cost industry or index type of super fund that's not expensive, that just grows in line with what the market gets. So you're not necessarily going to outperform it, but you're just going to build the fund up in a cost-effective way. So when we talk fees with super, there's usually a member or admin type of fee each month or year. Might be anywhere from $50 to a couple $100 a year. Sometimes more for those more expensive ones, up to, well, actually $500 for the super funds that offer you a range of different investments. And then super funds generally base their fees on a percentage of your balance, and the investment fees especially. So if you have $100,000 in super and you're paying 1%, for example, in fees in your super, that's $1,000. Whereas if you're paying 0.5%, that's $500. So have a look and see what the fees are on your statements. They usually break them down, or usually show them, I should say, as a dollar figure, but you can then divide that by your balance to get a rough idea of what the fees are. Anywhere from 0.5% to 1%, personally, for me, is okay. Getting above 1% isn't too bad if it's at the lower end, and if it's worthwhile, if you're getting specific investments that are required for you. If you're getting up at 1.5% to 2% of your super fund in fees, that's getting quite high, and that extra sort of 0.5% to 1%, when it's compounded over time, can really add up into a lot of extra costs coming out, and one of the things that does reduce your fund by potentially thousands of dollars. So the bigger the balance, the bigger the difference in those fees make as well. So it's important to make sure that you're in the right funds with the fees that are the right for you. So again, it doesn't have to be the lowest cost, but we don't want it to be too high at the same time. Again, I guess another caveat on this one is, as advisors, and when I look at people's super funds and review, for me, it's as much about, or more, I should even say, about net returns rather than pure fees. So if someone is in super fund A, which is more expensive than super fund B, but is providing a better net outcome or returns overall, that's fine. It might be because it's more tailored, there's some extra specific investments in there, or whatever it might be, it's a bit more aggressive. If that is what's right, and it might be 0.2 or 0.3% or even that 0.5% more than super fund B from a cost point of view, but the net performance is, let's call it 1% better, that is still a better outcome if it's the right thing for that person, because you're getting those better returns as long as it's in line with all of their requirements and comfort levels with the investment. So it's not all about fees, and again, that's why it's fourth on this list rather than at the top. Yes, they're important, but it is just one of those levers that we can pull out of the ones we spoke about. So that brings us to number 5 and the final one, which is adding more, or people not adding more to their super and not contributing extra to super. So I've done another video about this in an article that you can have a look at. But recapping quickly, a lot of research and study has found, not just in Australia but around the world, that the ideal contribution rate for people over their working career, so we're talking 30 to 40 years, to be able to replace their income fully in retirement, or as close to full as possible, is 15%. So what we mean by that is, of your income, 15% of that goes into, essentially, let's call it superannuation, your retirement savings. Right now, the compulsory amount that your employer will be putting in if you're an employee is 11.5%. If you're self-employed, there's not that requirement, but we'd really recommend you essentially doing the same. That will go up to 12% in July 2025. So you've got 3/4 of the way there almost being put in by your employer, essentially. So we just want to make up that difference to start with. Most people don't do this, and understandably so. There's a lot of cost pressures at the moment. Interest rates have gone up. Inflation over the last couple of years has kept increasing, and the cost of living is much higher than it was in 2 or 3 years ago. However, it's still very important to try and start putting some extra money in for retirement and well, for your future, really, for your future independence and financial independence. So to be able to do this, and a really good way that we recommend for people and find is, rather than taking money from out of the budget now and today, especially going from, let's say, 11.5% or even it's 12% in July 2025, straight up to 15%, that might be a pretty big jump. For someone on 100 grand, that's $3,000 a year. What we recommend is doing it gradually over a period of years, and each time you get a pay rise / promotion or start a new job with a higher salary, increase your contribution rate by 0.5% to 1%. So say you get a pay rise of just 2%, you could put half or elect to increase your contribution by 0.5%, so that an extra 0.5% of your income, of your new income, is going into super. So it's not a quick fix, and it's not going to impact anything now. And we find that people don't feel this because although inflation's going up, their income's usually going up similar or in line with that roughly. So taking a little bit out of that eases that burden so much that they don't even feel it. And it might take 3 to even 5 years to get to the 15% if required, but that is better than not doing anything and then finding out in 10 years time you're still not contributing any extra and not able to find that extra money. So if you're not able to contribute now, the best way to do it is over time. Each time you get a pay rise, depending on how much it is, just take half to 1% or of that of your income and increase your contributions by that. Easiest way usually is just salary sacrifice through your employer. They'll be able to help you out, whether it's they might want a form filled out, they might just want an email with how much you want to do, and you send that through and they'll be able to take care of it for you. So again, that is sort of one that's more potentially it needs to be done over time rather than right now, which the other 4 can be done, but a very important one that we find as well. So wrapping up, they're the top 5 issues that we see with people and mistakes that they make with their super, and how you can avoid those or fix them if you're finding that you're sitting in one of those camps. Each one of those in itself can cost people, and it does cost people thousands of dollars over a longer 20 or 30 year time frame if it's sitting there for that long. When you fix all of these mistakes, we're talking tens of thousands of dollars, even more, potentially if we're looking at a couple and that's per person over the period of their working careers. So it's really important to jump on this and get it done. It's one of those important, not urgent type of things, and parts of it may need some help and support and advice. And if you do want some, or if it's a need, let me know, reach out and we can have a chat and point you in the right direction to see what you need to be doing and the best way to help where you're at. Otherwise, thanks for watching and I'll see you in the next video.